In this video clip, I want to look at two other intergroup transactions. First of all, where dividends were paid or declared by the subsidiary, and secondly, where management fees were paid by one company in the group to another for management services delivered to them. Before I look at the adjusting entries, just recapping once again what the aim of consolidated financial statements are, and that is to provide information about the financial performance and position of the group as a result of its dealings with external parties only. So any intergroup transactions resulting in a profit or loss for one of the companies within the group needs to be eliminated in full on consolidation. So we eliminate the results of that transaction from the combined results to get to a set of results that only reflect our dealings with companies outside of the group structure. So when we look at the adjusting entries, always keep this in mind, because the adjusting entries has to move us from the combined results. So we have the parent company's set of accounting records. We add to that the full set of accounting records of the subsidiary. That gives us combined results, which is not reflecting only our dealings with external parties. It will also include intergroup transactions. So we have our consolidation worksheet adjusting entries, and in the end we then get our consolidated financial statements. So always keep in mind that we're aiming to identify what these adjustments should be. So how to move us from the combined results to a set of results only reflecting our transactions with external companies. Now I'm going to use the information in question 1710, just looking at the two sections, dividends that were paid and the management service fees paid. Now with regards to the dividends, the information regarding the dividends were contained in the summary of the financial information given at the start of the question. So we were given the basically an extract of the income statement of both the subsidiary and the parent company, and in that you can see that Zara Limited included an interim dividend that they've paid to the shareholders, and you can see that the parent company owns 100% of the shares in the subsidiary. So the full dividend that was paid was recorded, and that you can see in the column under Amy Limited, as dividend revenue in the parent company's accounting records. So from a group perspective, we'll take the set of results of Amy Limited, including dividend revenue of $1,000. We add to that the full set of financial results of Zara Limited, including a interim dividend paid of $1,000. And that gives us the combined result of the group, so including dividend revenue of $1,000 and interim dividend paid of $1,000. Now you can see from the combined results that the net effect of this transaction on retained earnings is going to be zero. So our retained earnings is not going to change with the adjustment entry that we pass. However, from a group perspective, our dividend revenue is overstated by $1,000, and our interim dividend paid is overstated by $1,000. Further to that, our aim of consolidated financial statements are to only reflect the transactions where we engaged with external parties. So we need to reverse this entry, because the dividends that we disclose in the final set of financial statements should only include the dividends that were paid or that are payable to external companies. So from a group perspective, our dividend revenue should be zero, because this is a wholly owned subsidiary, so no dividends is payable or paid to external companies, and therefore our dividend paid should also be zero. And the adjusting entry should be to move us from the combined results to what it should be for the group. So the dividend revenue should be reduced by $1,000, as well as the dividend paid line item. And this is exactly the adjusting entry that we'll pause. So we reverse the dividend that was paid against the dividend revenue recognized in the parent company, so that in the end our dividend revenue is going to be zero, and our our interim dividend paid zero as well. Same scenarios where management services are delivered. So we were told in the information that during the year the parent company provided some management services to the subsidiary at a fee of $500. So the parent company will have income as management fees recorded at $500. The subsidiary will have an expense for management fees of $500. So if we add this full set of accounts of the parent company and the full set of accounts of the subsidiary, the combined results would include an income of $500 for management fees and an expense of $500 paid for management fees. Once again, if we think of what the aim is of consolidated financial statements, from a group perspective, no management fees were earned, so this should be zero, and no management fees were paid, so that should be zero as well, because inter-company transactions should be fully eliminated. So how do we get from the combined results to what it should be for the group? We reduce the income with the 500 and we adjust the expense with the 500. And this is the consolidation entry that we need to pause. So other income is reduced by the management fees, other expenses by the management fees paid. Now the last thing you should then just take note of is that there's no tax adjustment in this case. Now remember, in the previous slides I mentioned that we only adjust for the tax effect if an asset or liability account is affected, where we adjust the carrying amount of an asset or a liability. This is an income statement, income and expense that is adjusted. It's adjusted in the current year. So the tax, the normal current tax deals with it in the current year, and there's no deferred tax implications. So don't make the mistake of adding a tax adjustment here. Okay, so that covered the dividends and intercompany services. If you have any further questions, you're more than welcome to post them on my Guru, where we'll be able to respond on it.